So then what else do we have to do? If we're going to invest in a more boring way, right, we have to determine a criteria for investment. This is something else that Ben Graham says. It is our argument that a sufficiently low price can turn a security of mediocre quality into a sound investment opportunity. For if the price is low enough to create a substantial margin of safety, the security thereby meets our criterion of investment. Right? So he talks about this idea of the margin of safety, which is the difference between the current market price and the intrinsic value or the fundamental value that they put on a particular stock or particular security, right? And he wants that margin to be as large as possible because that means if he were to be a little wrong, right, and may have, overstated the intrinsic value, then maybe still the market price can increase to whatever the intrinsic value is, and you can still make a good return. You can still make a nice return based on that margin of safety. So if a stock's price is low enough, right, if something falls enough, then it can become a good investment, right? Even if it's a mediocre company, it can still become a good investment. The margin of safety is dependent on price paid and is defined as the favorable difference between price on one hand and the indicated appraised value on the other. The overriding philosophy behind the investment requirements, there's really no such thing as a good or a bad stock. Instead, think of stocks as either cheap or expensive, right? If you're going to buy individual stocks, you either buy things that are on sale or you buy things that are overpriced. Right? And a lot of people who are buying into some of these speculative assets, I would say the vast majority are doing so at an overpriced valuation. They are overvalued. And the fact that they are overvalued means that you could really take a bath in it if those things were to crash in any amount. I know a lot of people who have gotten out of Bitcoin as Bitcoin has fallen nearly 50%. It had a little pop out of that, given that El Salvador took it on as a currency. But even so, right, those big drops scare people away when if you really believed in something, you would invest more. But in speculative assets, it is tough to invest more when you don't know what the actual value is in the first place. Look, there will continue to be wide discrepancies between price and value in the market. Now, sometimes those discrepancies will be where value is much greater than price, right, which is a good time to invest. And sometimes it will be where price is far greater than value, which is a time where you don't necessarily want to be investing as much, right? And there will continue to be these times, but those who stick to time-tested historical ways of investing, right, things that have been tried and true will win over the long term. Right? Whether or not you're picking individual stocks, whether or not you're picking individual securities to invest in, right? Which I've told you that most people should not, right? Most people should invest most of their money into index funds, into very low cost, low turnover mutual funds and ETFs that track with the market pretty close, right? Those are some of the most efficient investments for most individuals, right? And most people don't have the time or the want to do all the research that it takes to invest in individual stocks. And if that is the case, then you shouldn't be investing in them in the first place. The historic time-tested thing to do is to buy index funds, is to allow your wealth to grow little by little over time, because trying to gain it hastily will lead to you squandering it, right? Will lead to you betting on the next thing and that thing busting. Because what is the difference in, speculating in Dogecoin and going to a casino? There's very little difference. Right? Now, again, if you want to speculate with 5 to 10% of your portfolio, do it, right? But if you don't have any other portfolio, right, you need to start with some time-tested investment strategies. You need to start with some principles of investment where you are systematically putting money away and doing so in something that is going to go up over time based on history, right? Based on what has been proven to be true over time. Okay, it's something like investing in the S&P 500 index fund, right? Doing so systematically over time would make you very nice returns, right? So doing that is something that would be beneficial to most investors. Now, if you are trying to pick individual stocks, buy stocks that are undervalued, right? And hold them and hold them and hold them and hold them. Peter Lynch talked all the time, especially in One Up on Wall Street. He talked about how some of his best investment ideas didn't pan out for 7 years or 10 years, right? Is anybody in the market today really willing to hold anything for 7 years or 10 years? It doesn't feel like it, does it? It feels like people are trading. It feels like people are in and out really fast, trying to make quick money, right? But Peter Lynch was the best mutual fund manager that we have on record, right? The guy was averaging 29% a year over an 11-year period. That is insane. That's an insane return that you can create. And he beat everybody, including the Warren Buffetts of the world, right? And so he took a long time for his investments to pan out because he was buying based on value. He was buying based on what he knew, and he was buying based on the research and the analysis that he did. If you aren't willing to buy and hold, you're not an investor, you're a trader, right? You like to trade. You like to speculate. You like to jump in and jump out, right? But if you are trying to invest, right? Investing means that you are likely going to have to hold something for a long period of time. It is 100% true that 99% of investment returns are made when you are doing nothing. Most of your investment returns are not made by you actually trading or by you actually doing anything. Most of your investment returns are made by you sitting on your hands, by you being patient, by you not looking at your investment account every day, by you not checking stock prices all the time, right? I recently posted on Instagram and Facebook this quote from Warren Buffett that said, if you are willing to go Saturdays and Sundays without checking stock prices, which we all do because the stock market's not open on Saturdays and Sundays, he said, why don't you give that a try on weekdays? Because it seems like on weekdays, investors just want to have their face in their phone and checking the price every single moment, right? Buffett's also said, if you went and you bought a farm, right, you wouldn't go every single day and have that farm appraised. Why? Because you're not interested in what the value of that farm is tomorrow, right, or next week. You're going to buy that farm and you're going to hold that farm and use it for whatever assets it can produce for you, right? And then eventually one day it is going to appreciate in value based on the price that you bought it for, because obviously you wanted to buy it for an appropriate price, right? And at that time you'll have it appraised and you will sell it, right? But you're not going to go out every day and get your farm appraised. So why are you trying to go every day and see if the stock market is appraising your stock, appraising the company that you're investing in at a value that makes you want to act, makes you want to buy more or to sell or whatever, right? You don't have to act. A lot of times you can sit on your hands.